How's everyone doing? This is the early bedtime crew, right? My goodness. Late night last night for some of us.
I was well behaved.
You were well
reasonably.
behaved. I have a young team, and I'm too old. I said backstage, like, I'm too young to not realize that I can't hang out, and I'm too old to actually hang out with my team. But it's gonna be a good day. Thank you for everyone that showed up. I've been excited about this. I would say this is in my top 3. I'm doing like 30 sessions.
Thank you.
Or whatever the next couple days, and we have not sat down one-on-one together. Been a long time fan of yours, and I always like talking to other analysts because we're birds of a feather, right? So we're going to talk a little bit about kind of the state of the world, right? This is we're doing a few investor firesides, but specifically, I think your macro view is interesting, and I've followed your writing very closely for years. I just want to take a 30,000-foot view of where the world is going.
Yeah.
I think we might have a couple slides. Do we have a couple slides?
Yeah.
So we'll pull up. For this fireside, we have a couple of visuals from a report that Raoul has drafted. Is it out yet, or is it coming out?
It's been out, and it's part of this bigger framework that we'll talk about.
Yes. So I wasn't sure if, I know I've read it, I've seen it, but I wasn't sure if it was public yet. So we have a couple slides from there that are going to be kind of anchor points, and we're going to kind of go through them. But maybe just a bit about the kind of 30,000-foot view of kind of where you think things are right now, and we can pull up the first slide.
Yeah. So my view is quite different than most other people. My view is that this kind of great reset that people have been thinking about, right? We've got this excessive amount of debt in the world. Back in 2008, every major government on earth hit 100% of GDP in debt, and it blew up.
Yeah.
Because the private sector was 100% of GDP in debt, and so they're both crowding each other out. So there's not enough GDP growth to grow the world economy. Mm-hmm. So 2008, they did something clever, which was say, well, you don't need to pay interest. It's a debt jubilee, don't pay your interest, we'll just keep rolling your debts. Everybody in the world reset all of their debts in 2008, where the interest payments were at 0. Most of the governments in the world issued debt between 3 and 5 years. That created a cyclicality to the economy that's almost like clockwork, because every time we get to the debt refi cycle, which is currently right now, they end up having to cut rates and print money. What I figured out in this whole equation is that the whole world was being driven by this liquidity cycle of managing this debt. And it was all of the quantitative easing that's going on in the world was debasing currency. And this is kind of why crypto started. This is also why the halving cycle correlates entirely to the macro cycle, because they all birthed at the same time for the same reason, which was the excessive amount of debt and how the system's going to cope with it. What I found out in all of this was something much bigger, which was that all of the quantitative easing was just to pay the interest on the debt, and it's lagged. So I'm going to show you a few charts that just get across some of this point of view. So the first one is the chart.
I didn't realize you had the clicker.
Yeah, I've got the clicker. Is global liquidity.
Yep.
Global liquidity is what drives markets. The rate of change of liquidity is the single most important factor. And I'll show you a chart at the end will kind of prove the case. But for example, the NASDAQ is 97.5% correlated to global liquidity. The rest of it is the secular cycle of technology. But the business cycle gives us insights. Because we've got this perfect cyclicality, we've got insights from the ISM, which is the measure of the business cycle, looking forwards, actually mirrors liquidity perfectly. It tells us that we will see the economy continue to slow, which we've seen. We're getting towards the recovery phase of the economy, but liquidity keeps rising, and it keeps rising for a significant period of time. Why it keeps rising is this magic chart here, and I think I was the first person, or the only person to discover this, which was that the Fed balance sheet is lagged versus the interest payments that the government has to make. This is this monetizing of debt. So it's basically getting another credit card or using your credit card to pay your credit card debt. You compound it. But the way of not compounding it and getting rates exploding, which is what's happening now, because all of this new issuance is coming, they eventually put it onto the balance sheet. They put it onto the balance sheet, it rises, it debases the currency, and this magic happens, which is crypto being the fastest horse in the race when it comes to debasement, because it's in a secular trend, and it's kind of purposely built for this process, works very well. So this liquidity cycle for everybody in crypto is the single most important thing to understand. We know the secular trend, which is the adoption curve. You know, we're at 425 million users worldwide, and that trend keeps going and gets to well over 1 billion this cycle. But what we've got in front of us, while everybody's getting maximum bearish, is actually the next part of the liquidity cycle, which is going back to this, the printing of money to have to do this. Now, this could come two ways. It could come that they manage to keep rates high enough that inflation undershoots, which is what my view is. Or they go the Japan route and they do yield curve control. And that's printing money as inflation's rising and it trashes the currency, as we've seen the Japanese yen. So this macro backdrop of we're getting into the bottom of the cycle, inflation should keep rolling over because the lagging parts like rents and wages deflate for another 18 months. So even though commodity prices are rising, the bulk, 70% of inflation keeps falling. And that gives them the cover to cut rates. I think they pivot towards the end of this year. And the key thing for people to look at, if you think, well, how the hell do I monitor all of this stuff, is just follow the regional banks index. The moment the regional banks blow up, and they've been going back down towards the lows again, as soon as that blows up, we know what the Fed do. They've done it once already, inject liquidity. The other part of the equation is they're doing quantitative tightening right now, raising rates, but Fed net liquidity, which is the difference between the bond issuance from the Treasury General account, the reverse repo, and the balance sheet, it's actually loosening because they're draining the reverse repo. So they're kind of easing conditions quietly already, which is why markets have been better than expected. Markets are forward-looking as well, and they're expecting this.
Do you think it's fair to say there's two paths then? If the canary in the coal mine is the regional banks, I mean, is that not just marching towards gradual centralization of the entire financial system and of the money supply into something like a CBDC?
It always was.
Yeah.
It was always going that route from 2008. Mm-hmm. And don't forget, this has gone in waves.
But I guess my question is there anything that slows that down, or is it just a one-way path at this point to centralization?
With the world this much in debt, and debt not going, so the issue is there's not enough GDP growth.
Yeah.
So GDP is population growth, productivity, and debt growth. Debt growth hit its limit, so we're just now paying interest on the debt. Population growth is now shrinking in most major countries in the world, or slowing down dramatically. So we need productivity to grow. The only way of doing that is this technological revolution, of which blockchain is part of it, but that takes time.
Yeah.
So we've got this period, maybe for another 10 years, where there's no way around it outside of this. And that means that the banking system shrinks. And I think Europe will lead the way because its banking system has been broken for longer, and they will lead the way with CBDCs. The UK will do the same.
Well, and also whenever there's stress, there's quite a bit of political dysfunction just based on the way that the euro has been assembled. But so you brought up two paths. I think there's a third, but the number one would be inflation undershoots as the Fed pivots and basically the rates have worked. Two is yield curve control and quantitative easing, a redux. There is, maybe it's just those two, and the third is just a little bit of a flavor, but you've heard some people make the argument that, okay, this isn't great, but where else are you going to go, right? Japan's a mess, Europe's a mess, everybody's kind of in the same bucket. So it's like, if Bitcoin is the fastest horse, we're like, the US is the least dead horse? I don't know.
Yeah.
I don't know what the analogy would be, but like that whole concept of like, there isn't really an alternative, so yes, it's bad, but it's worse elsewhere, so.
That's why the dollar is 87% of world trade. Dollar debts are 400% of global GDP. it's an entirely dollarized world out there.
Yep.
And we can see the squealing from almost every other country saying we don't want such a reliance on the dollar because this dollar business cycle drives everybody.
Yep.
But yes, I mean, there's no option, there's no alternative to the dollar in a meaningful scale, except this parallel system that's being built, but it's not yet at the scale to do it.
Yeah.
So that's why the rise of stablecoins has been so big, is because people want access to dollars. And if you're a worker in the Philippines and you want dollars, the easiest way is a stablecoin because you can't get it via the banking system because you pay so many fees.
Scenario number one, though, is that the soft landing?
No.
Where inflation, the Fed pivots and inflation undershoots?
I still think we are going to, we've probably been in a recession for a while. You know, we've seen it, everybody's laid off staff, everybody's slowing down growth, everybody's seen slower sales, and I think that those numbers get solidified. I think GDP growth gets downgraded again, and I think the likelihood is of negative GDP in Q4 and maybe Q1 as we start, because as the ISM starts picking up again, GDP actually lags that by a quarter or two. So I actually think the recession comes, but it's mild. It's like 1990. While everybody's looking for the apocalypse, I think the apocalypse can't happen. The apocalypse of 2008 can't happen again because you've got the magic bullet, which is we just print money, and what printing money does, it optically rises the value of the collateral. So in a debt system, it's the collateral that matters more than anything else. It's interest payments and collateral. And those are the two things that quantitative easing controls.
I'm more scared now than I've ever been because you just said, oh, it can't happen again, it's a silver bullet. You just said like 3 things in one sentence that I'm like waiting for the asteroid to hit us at this point. We've heard this song before where it's like, oh, well, and then we get surprised in 6 months or a year. You know, if it actually sounds like you're relatively optimistic.
Well, don't forget, last year, assets priced in the recession. People have forgotten this.
Yeah.
They're screaming for, where's my 50% downdraft? Well, the NASDAQ was down 38% last year. Crypto was down 80% last year. The S&P was down 25, 30%. We had it last year because assets have become forward-looking, waiting for the cowbell. Every time the cowbell comes, they know it's coming, and they start forward pricing it. So it's just working on this liquidity curve. As soon as liquidity bottomed, I added to my ETH and crypto positions in June as liquidity bottomed, and then when it confirmed, and that's worked well as a thing, and forward-looking liquidity keeps rising.
Let's apply this to crypto in general, right?
Yep.
So one line of argument that I think is starting to pick up steam again is Bitcoin versus ETH as the primary crypto store of value, right? And there's arguments for both. How do you think about allocating to, if the fastest horse is crypto, is it still all about Bitcoin? Is ETH starting to gain prominence here? Are you starting to think about, okay, if ETH does well, Solana is going to do better? Or, you know, where do you go down like the crypto risk curve if your thesis is, so, you know, we're in this part of the cycle and now is the time that
so what's amazing is, like all risk curves, it's completely correlated to the business cycle. So let's take any emotion, tribalism, or anything else. We're in crypto spring right now. We're about to transition to macro spring. That crypto spring period, Bitcoin tends to outperform, much like US Treasuries outperform in macro spring. Then you get the part where liquidity starts really flowing, and so money flows out the risk curve. That's what drives the Bitcoin ETH cross, and I don't have the chart to show it, and also the alts versus the alt space versus Bitcoin and ETH. So what you find as liquidity rises, it goes out the risk curve. So for me, I think ETH is a faster horse over time. If I look at the ETH Bitcoin cross, it's tended to outperform over time. No, nothing wrong with Bitcoin, it's just we're also trying to make money out of assets as well as grow the ecosystem. And so I see the ecosystem grows faster, and then I'll look out to something like Solana, and I look at like Metcalfe's law metrics for adoption, number of wallet uses, the amount of transactions on chain, the value on chain, which I use the Messari data for, just to give you a plug. And that's when you find that things like Solana should massively outperform Bitcoin. And they seem to be phased. So Bitcoin seems to pretty much follow ETH seems to follow Bitcoin's previous cycles. Solana seems to follow ETH's last cycle because of this cyclicality. So although the bulk of my investments are in ETH, I have a reasonably large Solana position and I have some other stuff, but it becomes harder with the other stuff to know what's going to outperform because I'm a macro guy and not the picker of, I'm going to get the next 100x. I'm just not good at that. But on the macro basis, just using the same framework, if we are right in the liquidity cycle, then we'll see the liquidity cycle in crypto move out the risk curve.
So your very simple thesis on crypto is here's how it's going to fit in a macro context, here's where it should fit in my portfolio, and then here are the couple of network plays that are going to give me the indexed exposure to the asset class. And for you, that's still going to be the network tokens and the ones that have the primary ecosystems.
Yes. So for me, what I'm trying to do is outperform just holding the space overall.
Yes.
So outperform, let's say, the Bitwise basket, something like that.
Yep.
If I can do that by just making some relatively sensible asset allocations, I think that's fine. And then, I own a reasonable amount of NFTs because I think of those as, and I've been using this bear market in NFTs. I love a good bear market where everyone questions the thesis. NFTs are not going away. It's hard to know which ones to own, but I think of them as a call option on ETH as well. Mm-hmm. So, right now, let's say a punk is $70,000, whatever that is in ETH. Well, what is the probability that as ETH rises, people get more money, they want to buy trophy assets, they buy punks go from here, go up 3x, 5x. Well, that's a massive kicker on the ETH trade. So I'm just trying to structure my portfolio because, this is a secular trend. So even though the macro is cyclical, it's the secular trend you're trying to capture. And what's interesting to me about NFTs is they exactly track secondhand Rolex watches. And it's because it's the same dynamic.
Yep.
Right, there's no money circulating in the ETH economy right now. The ETH economy is just coming out of recession, or call it the crypto economy overall. It's coming out of recession. Nobody's got gains to go and buy their fancy Rolex watches. Same in the traditional economy. So NFTs get trashed. They lag. They're just a lagging asset, like housing is a lagging asset in the traditional economy.
Yep. The IRS hired 90,000 agents right in time for none of us to have gains.
Exactly.
Good luck.
Or you live in the Cayman Islands like me.
Oh, man. You got it all figured out, man. When you talk to other institutional investors and some of your clients at Real Vision, do you see the sentiment changing? I mean, obviously you're helping educate them on a number of these issues, but are you seeing a sentiment shift? Are they a laggard like some of these charts? Or like what signs of life are you looking for in that sphere for people that are thinking about building positions coming into the space? I talked to Scaramucci yesterday. He said the Bitcoin ETF is underrated in terms of what it's going to do for institutional adoption. But what are some of these conversations that you're having in light of some of these?
Yeah, so I look at the space in where does the big adoption come from? So I think the two biggest forms of adoption are the financial system, using it for its rails, and we're seeing that moving forwards, whether it's Franklin Templeton, Fidelity, or a whole bunch of other people. I've even had a friend of mine at National Australia Bank in Australia has built 5 stable coins. I'm like, why are you building stable coins in different currencies? He said, well, nobody realizes we're in Australia. We're a massive investor in US equities. US equities are going to T+1 settlement. FX is T+2, and we're in Australia, so that's T+3. He said, we can't settle any equity trades. So we need stable coins. So you'll start to see the financial system adopt it. That's an Australian bank.
Yep.
So I'm seeing that happening, but it's going to be slower because of regulation and everything else. The other side is the brands and culture. And brands and culture are adopting it. We're seeing all the car companies, most of the sports teams, fashion companies, everybody are building into this space. So I think that's a big on-ramp to people. Institutional investment, they tend to be laggards. The family offices have been first because they can take more risk. But we're seeing pretty much every institution I speak to, whether it's a pension fund or endowment or anybody else, have done the work on it. But they are sheep. They want price to rise. So let's assume that Mooch is right. The Bitcoin ETF comes. That allows the RAAs to get involved. That starts pushing the price up a bit. Let's assume the macro recovers somewhat, the rates are on hold, everyone feels a little bit easier. Well, before you know it, Bitcoin's at 45,000, and then the panic starts. Because I think of the entire institutional investment space who've done all the work on this as like short call options. So if the price rise, they're forced in. And so I think we'll see that dynamic play out. So we've got the mass adoption on the culture side, financial system using it as the rails, and then the capital to come into the space.
There's so much to unpack in the brand comments and the culture side that you just kind of open that door. We're at time. But the good news is we have one of the foremost thinkers on this space who's in the back corner smiling. You just set her up. Colleen
I bet,
from Brevin Howard is going to be doing a presentation on this in just a little bit. So stick around for that. Raoul, thank you so much for coming. It's a treat, and we'll do it again soon. So
fantastic.
thanks so much.
Really enjoyed it.
Thank you.
Thanks, everyone.